The Crypto Tax Guide 2022. ApointResearch.com. Please subscribe and comment on the video. Do you have to pay taxes on cryptocurrency? Yes, you'll have to pay tax on cryptocurrencies in the United States, and pretty much anywhere else in the world. Cryptocurrency is not considered a currency in the United States. Instead, it's treated like any other piece of property, such as a stock or rental home. Want to earn income on your crypto assets? Click in the BlockFi link in the description and earn 9% per year in your cryptocurrency. Get up to $250 in Bitcoin for funding an account. Is it possible for the IRS to track cryptocurrency? Yes, the IRS can track cryptocurrency transactions. So, if you're wondering if you have to pay taxes on crypto earnings, the answer is yes. Is it true that the IRS is aware of my cryptocurrency holdings? Come to a complete stop right there. The IRS has stated that it is collaborating with cryptocurrency exchanges such as Coinbase, Binance US, and Kraken to share client information in order to guarantee that crypto investors appropriately report their profits and income. Coinbase has confirmed that each investor who earned more than $600 in a financial year receives a Form 1099 miscellaneous, which is sent to both the investor and the IRS. Though we've specifically mentioned crypto exchanges, any crypto exchange that uses Know Your Customer, KYC, identification could be asked to submit this information with the IRS. This information is being used by the IRS to send letters to American crypto investors reminding them to record their transactions and pay their crypto taxes, as well as to conduct audits and take assets from individuals who are dodging taxes. The most effective strategy to stay tax compliant is to appropriately submit your crypto taxes to the IRS. In the United States, how is cryptocurrency taxed? Because Bitcoin and other cryptocurrencies are considered property for tax purposes, they may be subject to either income tax or capital gains tax. The Bitcoin tax you'll have to pay is determined by the sort of crypto transactions you make. We'll take a look at both of them. Cryptocurrency capital gains tax. Because crypto is treated as a capital asset for tax purposes, you'll have to pay capital gains tax if you sell it. In the United States, there are 4 ways to get rid of your cryptocurrency. Cryptocurrency is being exchanged for fiat currency. Swapping one cryptocurrency for another. Using cryptocurrency to purchase products or services. Gifting cryptocurrency, above the $15,000 barrier for 2021, $16,000 for 2022. You won't have to pay capital gains tax on the entire proceeds of a crypto sale, just any capital gain, profit, would be taxed. Rate of taxation on cryptocurrency capital gains. There isn't a set rate for crypto taxes. It's all dependent on the provisions of the capital gains tax. The rate of capital gains tax you'll pay on your cryptocurrency is determined by how long you've owned it and how much you earn. You'll pay the short-term capital gains tax rate if you've owned it for less than a year. You'll pay the long-term capital gains tax rate if you've owned it for more than a year. You'll pay the same tax rate on short-term capital gains as you do on ordinary income. This is based on the tax brackets used by the federal government. Tax rate on long-term capital gains. Meanwhile, crypto has a substantially lower long-term capital gains tax. So, how much tax do you pay on your cryptocurrency profits? The difference in value between when you bought your cryptocurrency and when you sold it is known as a capital gain or loss. You'll have a capital gain or loss whenever you sell, swap, or spend your cryptocurrency. You'll have a capital gain if you made a profit on your crypto disposal. You'll have a capital loss if you lost money on your crypto disposal. It's simple enough to figure out your crypto capital gains and losses. To begin, you must determine your cost base. Your cost basis refers to the price you paid for your crypto asset, including any transaction costs. If you obtain the cryptocurrency for free, for example, if it was a gift, you'll use the fair market value of that cryptocurrency asset in USD on the day you received it. Tax exemptions for cryptocurrencies. Once you've determined your cost basis, just subtract it from the asset's value on the day you sold it to determine whether you made a profit or a loss. If you make a profit, you must pay capital gains tax on it. You won't have to pay capital gains tax if you incur a loss, but you should keep note of them because you can use them to offset gains. More on this later. Let's look at an example to see how much cryptocurrency is taxed. Gifting crypto for less than $15,000, you can give up to $15,000 in cryptocurrency to each recipient tax-free. The annual gift tax exclusion is what it's called. This allows you to take advantage of reduced income tax rates in your household, resulting in a lower overall tax bill. Anything worth more than $15,000 will be taxed. Allowance for capital gains tax exemption. If you earn less than $40,000 in the fiscal year 2021, you will not be subject to capital gains tax. Long-term capital gains tax rate. If you keep your crypto for more than a year, you'll pay a lower long-term capital gains tax rate of 0% to 20%, depending on your earnings. Losses in cryptocurrency capital. Any crypto capital losses are not subject to capital gains tax. But don't dismiss these as a waste of money, instead, put them to good use. You can minimize your tax burden by offsetting your capital losses against your net capital gain for the year. There is no limit on how much capital loss you can write off in a single year in the United States, so if you have enough losses, you can write off your whole net capital gain and avoid paying any taxes. The good news keeps on coming because if your capital loss exceeds your net capital gain, you can deduct up to $3,000 in capital losses from your regular income, lowering your overall tax payment even more.